Hello everyone. In previous lecture we discussed about the 5 C's of the credit standards. How can we make a selection criteria of the customer to whom we are granting a credit or to whom we are selling our product on credit. So in this lecture we discuss about the changing credit standards. Sometimes there is a need to change the existing credit standards. So in this lecture we discuss how can we evaluate whether we should change our credit standards or not. We will do cost and benefit analysis. In this question I have one question here, and we will decide in this question whether we should change the credit standards or not in this specific scenario. Let's start. Alex Tool, a company, a manufacturer of tools, is currently selling a product at $10 per unit, and the current sale is 60,000. The variable cost per unit is $6. The firm's fixed costs are $1,20,000. The firm's proposed plan is to increase average collection period from 30 days to 45 days. It means that currently the average collection period of the company is 30 days, but company want to increase these average collection period days from 30 days to 45 days. They want to change their credit standard. Currently their credit standard is 30 days. They collect their target is to collect accounts payables within 30 days, but they want to increase these days to 45 days. And after increasing average collection period to 45 days, sales will increase 5%. It is expected that the sale will increase by 5% if we increase the average collection period days from 30 days to 45 days. And bad debts increases from 1 to 2%. This is also expected that the bad debts will increase and the sales will also increase if we increase days from 30 to 45 days for average collection period days. And the cost of tying up fund is 15%. So this is the one question, and in this there's a need to decide whether we should increase the average collection period from 30 days to 45 days or not. So let's start to solve it. So first of all, for deciding about whether we should increase these days from 30 to 45 days in average collection period, first of all we will calculate additional profit contribution from sales. Additional profit contribution from sales. So how can we calculate additional profit contribution from the sales? So if we increase the days from 30 to 45, then our sale will increase by 5%. So currently we are selling, current sale is 60,000. If current sale is 60,000, and how much sale will increase? Sale will increase by 5%. So 5% of 60,000 is 3,000. So it means that our sale will increases by 3,000 units. So here we are talking about the additional profit margin. If we increase days from 30 to 45, our sales units will increase by 3,000. And our profit margin will increase by, how can we calculate a profit margin? Sales price. So per unit profit margin is sales price per unit minus variable cost per unit. So here sales price per unit is 10 and variable cost is 6. So 10 minus 6 is 4. So we will produce 3,000 extra units on these 3,000 units. On every unit we will get profit margin of 4. So 3,000 multiplied by 4 is equal to $12,000. $12,000. So it means that our additional profit contribution from the sale will be 12,000 if we increase average collection period from 30 days to 45 days. So in second step, we will calculate the cost of marginal investment in accounts payables. cost of marginal investment in account receivables. So we can calculate a cost of marginal investment in account receivables if we have a data of investments in account receivables in 30 days plan and investments in account receivable for 45 days plan. So then we will take a difference to calculate a marginal investment in account receivables, and then we calculate a cost of marginal investment in account receivables. So first of all, we will calculate a average investment in account receivables, and the formula of average investment in accounts receivable is total variable cost divided by 365 multiplied by average collection period. So in this case, first we calculate a average investment under proposed plan. Average investment in account receivables in proposed plan, and we calculate this by using this formula, and this will be equal to, in proposed plan our total sales will be, like our current sale was 60,000 and then we produce extra 3,000, so total sale will be 60,000 current sale and 3,000 extra sale if we go from 30 days to 45 days. So in proposed plan our new sale will be 63,000 units, and in current plan we are selling a 60,000 units. So now we can calculate a variable cost. 63,000 units, total variable cost can be calculated by units multiplied by variable cost per unit. So here variable cost per unit is 6, 63,000 multiplied by 6. So whole answer of 63,000 multiplied by 6 is equal to the total variable cost divided by 365 and multiplied by proposed plan. In proposed plan the average collection days are 45 days. So that's how we can calculate a amount average investment in accounts receivable in proposed plan, and this amount is 46,602. 46,602. Now we calculate average investment in account receivables in current plan. So we can calculate it by, and in current plan the sales is 60,000 units. We are selling 60,000 units and the variable cost is 6 divided by 365 multiplied by 30 days. So currently average collection period is 30 days. So whole answer is 29,589. That means that currently we need 29,589 to finance account receivables, and in proposed plan we need 46,602 to finance account receivables, and here we need to calculate marginal investment in account receivables. So in third step we can calculate marginal investment in account receivables by just taking a difference, proposed minus current plan. So proposed minus current plan investment is equal to 46,602 minus 29,589 is equal to 17,013. It means that we need 17,013 dollars additional if we go from 30 days to 45 days of average collection period. We need additional $17,013 to finance account receivables, and we can calculate, and our objective was to calculate the cost of marginal investment in account receivables. And up to this stage, we have calculated a marginal investment in accounts receivable. We can calculate a cost of marginal investment in accounts receivable by multiply it by 15% because the cost of tying up fund is 15%. If you borrow this much additional amount from the bank, then the bank will charge us a 15% interest, and that's how we can calculate a cost of marginal investment in accounts receivable by multiplying marginal investment in accounts receivable multiplied by cost of tying up fund in accounts receivable. So the whole answer here is 2552. 25 and 52. It means that if we go from 30 days to 45 days average collection period policy, additionally when we will bear a cost of $2,552 against the financing of account receivables. And thirdly, we calculate a cost of marginal bad debts. Cost of marginal bad debts. And we can calculate a cost of marginal bad debts by calculating a bad debt under proposed plan and bad debt under current plan. Bad debts under proposed plan, and we need to calculate bad debt under current plan. So we can calculate a bad debts under proposed plan by multiplying. Right now in proposed plan we will sell 63,000 units and we will sell every unit at a price of 10. So 63,000 multiplied by 10 is equal to 6,30,000. So our revenue will be 6,30,000. And on whole revenue, our bad debts are right now 1% in current plan. In proposed plan, the bad debts are 2%. And here we are talking about the proposed plan. So revenue multiplied by 2%. If we multiply revenue by 2%, that's how we can calculate a bad debts. Because on revenue, the bad debts will be 2%. So the answer here is 12,600. And in current plan, we can calculate a bad debts by multiplying 60,000 units multiplied by 10. So it means that overall revenue will be 6 lakh. And on this whole revenue, the bad debts will be 1%. So multiplied by 1%, the whole answer is 6,000. So if we go for a proposed plan, so we will bear marginal bad debts. Marginal bad debts mean if we go for a new plan, we will bear 12,600. In current plan, the bad debts are 6,000, and the difference of both these 12,600 minus 6,000 is equal to 6,600. So it means that if we go for a proposed plan, we will bear additional cost of 6,600 against the bad debt. We will bear a 2,552 cost against financing of the accounts receivables additionally, and we will get a benefit of 12,000 extra CL if we go for a new plan or proposed plan. So if we go from 30 to 45 days, this is the benefit and these two are cost. So if we subtract cost from the benefits, we can calculate overall net profit from implementation of proposed plan. We can calculate it by 12,000 minus 2,552 cost of marginal investment in accounts receivables, and then we deduct 6,600 cost of marginal bad debts, and the whole answer is 2,848. So if this answer is positive, it means that we should implement a proposed plan, and if this if this answer is negative, we will not implement the proposed plan. So in this case, the answer is positive. It means that we can go from 30 to 45 days, and if we go from 30 to 45 days average collection period, we will get extra benefit of 2,848. Thank you so much. That's how we can evaluate the changing in credit standards.